Welcome to TRAIN2INVEST's economic forecast for the first quarter 2024. This broadcast comes in two phases. Phase 1 is for public consumption, while Phase 2 is limited to existing clients only. If you have any questions, comments, etc., please go to www.train2invest.com and fill in the Contact Us form. Thank you. Disclaimer. Examples used here are suggestions and not recommendations. These suggestions are based on available information that is time-sensitive and for education purposes only. By continuing to watch this webcast, it is deemed that you have accepted the above. Background: Toronto Stock Exchange, TSX, Summary. The Toronto Stock Exchange is the largest stock market in Canada. The exchange is fully electronic, with more than 1,700 companies listed. All transactions are conducted in Canadian dollars. TMX Group owns several subsidiaries that operate equities, derivatives, fixed income, and energy market exchanges. These include the Toronto Stock Exchange, TSX, and TSX Venture Exchange, TSXV. TSX performance 2020 to 2023. Looking at the chart from left to right, you will see that on February 17, 2020, the TSX was approximately 18,000 points. Then COVID hit. By March 23, 2020, the TSX dropped to almost 11,200 points, the decline of 6,800 points. However, within 1 year, that is, by January 4, 2021, the TSX reached 18,000 points, pre-COVID levels. It hit a record on April 4, 2022, at 22,200 points. Since May 2022 to the current period, that is, November 2023, it has a range of 2,500 points, trading between 18,500 points and 21,000 points. Please note that between May 23, 2020 point A on chart, and April 4, 2022 point B on the chart, the TSX increased by 11,000 points. That is a 98% increase. For the novice, stocks, 1 point equals $1. So, when you hear that a stock lost or gained X number of points, it is the same as saying that the stock lost or gained X number of dollars. What are the main challenges that we may face in 2024? Global inflation, excessive money supply by government spending, interest rate hikes by central banks to curb inflation, recession fear caused by high interest rate fears, climate change, legal rules requiring higher gallon mileage, and electric vehicle subsidies. Crude oil challenges, recession fears caused higher inventory stockpile. Russia-Ukraine war created the global food crisis. U.S. border crisis, illegal immigration crisis, and potential terrorist activity. China-Taiwan possible war. North Korea expansion of military aid to Russia and Iran. Israel-Hamas war possible expansion into the Middle East. Turkey, Iran, North Korea, Russia, China axis of evil. Trudeau ticked off India, China, USA, Italy, etc. Economic growth drives the stock market. What is needed for economic growth? Natural resources, the need to explore and develop new natural resources. It is the backbone of the Canadian economy. Infrastructure, upgrading infrastructure, is critical for the country as breakdowns will severely impact the production and delivery of goods. Human resources, the development of universities and the immigration of qualified technology, etc., experts are necessary to compete in the global market. Deregulation, unnecessary regulations will stifle industry. For example, the Biden energy regulations reduced the U.S. from an energy exporter to an energy importer. Taxes, excess taxes will destroy industries. For example, subsidies introduced for electric vehicles had a major impact on the auto industry. Innovation and technology essential for growth of industries. Current challenges. Climate change agenda. The Canadian government's commitment to be carbon neutral has limited resources being taken away from critical industries. Supply chain issues. Canada's continual dependence on China has caused supply chain problems in Canada. Inflation and higher interest rates. The fear of inflation has caused the Bank of Canada and the U.S. Federal Reserve to boost interest rates to historical highs. This is very disruptive to both the large corporations and to small business. Housing and food crisis. The high interest rate scenario has led to a housing crisis in Canada, and the Ukraine war has caused a food crisis globally. Political problems. There is a challenge on Prime Minister Trudeau and Liberal Party on corruption issues. This may lead to an early election if the NDP pulls out of its deal with the Liberal Party. Social challenges. The diversity and abortion issues has created social problems and has led to a divided society, which creates challenges in the workplace, etc. GDP versus the TSX. What is GDP? GDP means the gross domestic product. This accounts for total goods and services produced by companies for one calendar year. What is market capitalization? Market capitalization is the number of shares multiplied by the current purchase price. This chart shows the total market capitalization of all the companies in the stock exchange. As you can see from this chart, the GDP growth is reflected in the stock market growth. Therefore, anything that stifles GDP growth will severely impact the stock market growth. Timeline, 3-month forecast. As we look at the past performances of the TSX and attempt to make an educated guesstimate on what will transpire in the first quarter 2024, keep in mind the following caveat. This is a short-term forecast, that is, it is for 3 months only. It is possible that we may be right about 60% of our estimates. These forecasts are not carved in stone. That is, we will adjust as more data comes to light. Geopolitical events may be the game changer. What are the main challenges for Canada? Inflation and the Consumer Price Index, called CPI for short. The GDP growth rate. Banks' prime lending rates. Housing starts. Unemployment rate. Manufacturing PMI. Consumer confidence. Let us examine a few of these challenges. Inflation, the COVID contribution. Massive government intervention through stimulus spending which contributed to high inflation, never seen in 20 years. When the economy was shut down by the government decree, there was excess supply which initially reduced inflation. But as the economy opened, pent-up demand coupled with supply constraints caused a surge in inflation. The chart shows the blue columns as CERB plus wage subsidy. You can research this if you want to know more. Just Google CERB results. Inflation, causes. As the economy reopened, Canadians were anxious to catch up on things they had missed, so a lot of spending shifted from goods back to services. But businesses, many of which had laid off employees during the lockdowns, struggled to hire and train enough staff to meet the spike in demand. This resulted in labor shortages that placed even more pressure on production costs. With demand increasingly strong and supply chains still impaired, many businesses began passing on higher costs to their customers by raising prices. These conditions resulted in global inflation taking hold in Canada. Inflation, solution. The solution to high inflation is the raising of interest rates by the Bank of Canada. The Bank of Canada held its target for the overnight rate at 5% for a third consecutive meeting in December 2023, in line with market expectations, leaving borrowing costs at a 22-year high. Policymakers noted that there are further signs that monetary policy is moderating spending and relieving price pressures, but remain concerned about risks to the outlook for inflation and are prepared to raise the policy rate further if needed. Our forecast is that interest rates will start coming down in 2024. Canadian inflation rate. The annual inflation rate in Canada fell to 3.1% in October of 2023 from 3.8% in the previous month, slightly below market expectations of 3.2%. The result was softer than the Bank of Canada's forecast that inflation is likely to remain close to 3.5% through the middle of next year, strengthening market bets that the central bank is unlikely to deliver another rate hike. Crude oil price challenges. Oil prices fell sharply on December 6, 2023, Wednesday, extending losses to a fifth straight day, after data showing a large increase in gasoline inventories in the U.S. in the week ended December 1, raised concerns about the outlook for fuel demand. According to the data released by the Energy Information Administration, EIA, this morning, gasoline stocks surged 5.4 million barrels last week, more than 5 times the expected increase. The EIA data also showed crude inventories dropped by 4.6 million barrels last week, much more than the expected drop of about 1.4 million barrels. Data from industry group the American Petroleum Institute showed Tuesday that crude oil inventories in the U.S. rose by 594,000 barrels in the week ending December 1, versus expectations for a draw of over 2 million barrels. Despite the decision of the OPEC Plus group to extend their voluntary output cuts of 2.2 million barrels per day till the first quarter of the coming year, oil prices kept sliding this week. Saudi Arabia and Russian officials stated on Tuesday that the cuts could be extended or even deepened. There is skepticism over OPEC Plus's recently announced voluntary supply cuts due to fractures within the alliance. Analysts wonder whether Riyadh could abruptly reopen the taps to maintain market share, similar to a move in 2014 to counter rising U.S. production. Worries about the outlook for fuel demand in China due to the slowdown in the world's second-largest economy continued to weigh on oil prices. Moody's downgraded its outlook for China's government credit rating to negative from stable on Tuesday. Meanwhile, data released earlier today by the General Administration of Customs showed China's crude imports dropped to their weakest in 4 months in November, trumping bullish demand forecasts from leading industry participants. Crude oil forecast. Crude oil decreased $10.47 per barrel, or 13.02% since the beginning of 2023, according to Trading on a Contract for Difference, CFD, that tracks the benchmark market for this commodity. Crude oil is expected to trade at $76.08 per barrel by the end of this quarter, according to Trading Economics global macro models and analysts' expectations. Looking forward, we estimate it to trade at $82.46 in 12 months' time. Major unknown. War in Middle East could close the Strait of Hormuz, where almost 60% of global crude oil is shipped. For suggestions on energy stocks, refer to Phase 2, clients only. Canada housing starts. Housing costs impact. A. Banks' loan repayments and bankruptcies. B. Consumer spending. How much of income goes to mortgage payment or to rents? Housing starts in Canada edged up by 1% over a month earlier to 274,700 units in October 2023, above market expectations of 252,900 units, according to the Canada Mortgage and Housing Corporation. The seasonally adjusted annual rate, referred to as SAAR, of total urban starts increased by 2% to 257,357 units, as single-detached urban starts jumped by 9% to 47,470 units, while multi-unit urban starts went up by 1% to 209,887 units. The rural starts monthly SAAR estimate was 17,324 units. Canada retail sales year-over-year. Retail sales in Canada increased 2.71% in September of 2023 over the same month in the previous year. Retail sales year-over-year in Canada averaged 4.62% from 1992 until 2023, reaching an all-time high of 55.7% in April of 2021, and a record low of -30.30% in April of 2020. Market forecast, first quarter 2024. There is rarely a straight line between uncertainty and market outcomes. 2024 will usher in a mild recession based on inflation data and Bank of Canada interest rate strategy. Consumer resilience will be tested under the weight of declining real incomes, higher debt service costs, and thinning savings. What portion of the consumer income goes to mortgage payments or rental costs? Markets are coming around to the idea that the Bank of Canada will be forced to start cutting rates by late next year, shifting their bets a day after Governor Tiff Macklem and his officials downgraded the growth outlook. Statistics Canada reported the country's payrolls shrunk by 46,800 positions, or 0.3% in August, and job vacancies continued to decline, confirming a loosening in the labor market. Gross domestic product is expected to expand by 0.2% annualized, on average, from the third quarter of 2023 through the first quarter of 2024, according to a Bloomberg survey of economists. Summary. Positives. Inflation is decreasing and it's likely that interest rates will come down in 2024. Crude oil prices are tracking below $80, which is positive for the overall economy. Carbon tax, hopefully, this will be fully removed or at least temporarily halted. USA, anticipated positive economic news will cause US stock markets to grow. Negatives, war explodes in Middle East, potential for World War III. Consumer spending goes against consumer income, credit card debt. Carbon tax, massive government regulations that will cause immediate impact on the economy and then the stock market. Global recession due to illegal migration, etc. TRAIN2INVEST background information. Established in 2004, TRAIN2INVEST is Northern America's leading investment and education and training corporation. Its methodology is teaching, training and coaching in the art and science of investing with a foundation based on capital preservation. Please go to www.train2invest.com and download the free ebook, The Stock Market, The Untold Story. Testimony: stay-at-home mom turned into a savvy trader. The screenshot of her trading account shows that she had achieved approximately 94% return in 3 years. Testimony: Junior Rocks, a teenager with $6,000 generated a return on investments, ROI, of 17% from January 2023 to April 2023. Thank you. If you need additional information, please go to our website www.train2invest.com and register for details. Alternatively, just email admin@train2invest.com with your comments, concerns, etc., or you could call us at 20441499106 and leave a voicemail. Check out our Instagram, YouTube channel, TikTok, Twitter, X, Facebook. Thank you for listening to our forecast first quarter 2024.